Federal Reserve publishes a weekly report that almost no one reads. It is called the H4.1 release. It contains data on reserve balances, treasury holdings, and the various lending facilities through which the Fed interacts with the banking system. Buried in last Friday's release was a data point that should have been front-page news. 5 of the 8 largest banks in the United States have drawn their reserve balances down to levels that meet, but do not exceed, their minimum regulatory capital requirements. They are not below the minimums. They are at the minimums. This is not a violation. This is not a crisis in the technical regulatory sense, but it is a signal. Banks do not operate at minimum capital levels by choice. They operate at minimum levels when they have no excess, when every available dollar has been deployed, when the buffer between solvency and stress has been reduced to zero. 5 banks. $800 billion in combined reserve reductions over 18 months. Capital buffers that once provided cushion against unexpected losses now provide nothing. The banking system has not failed. The banking system has reached the point where failure becomes possible. And when the institutions that create credit, that intermediate savings, that form the circulatory system of the modern economy reach minimum capacity, the question is not whether stress will emerge. The question is what triggers it. There is a standard narrative about bank capital requirements. The narrative suggests that capital requirements exist to ensure bank safety. Regulators set minimums. Banks hold buffers above minimums. The buffers absorb losses during stress. The system remains stable. This narrative is accurate as description. It is incomplete as analysis. Capital requirements are not merely safety measures. They are indicators. They reveal how much capacity exists within the banking system to absorb unexpected events. When banks hold substantial buffers above minimums, the system has capacity. Loans can be extended, losses can be absorbed, unexpected withdrawals can be accommodated. When banks operate at minimums, the capacity is gone. Every new loan requires careful calculation. Every loss threatens the threshold. Every unexpected demand creates potential crisis. The 5 banks now at minimum capital are not obscure regional institutions. They are systemically important financial institutions. The banks deemed too big to fail, the banks whose failure would trigger cascading consequences throughout the financial system. These are the banks that the 2008 crisis was supposed to have strengthened. These are the banks that absorbed hundreds of billions in bailout funds and were subjected to stress tests designed to ensure they could survive severe economic scenarios. They are now operating without buffers. The question is not whether the regulations are being followed. They are. The question is what depleted the buffers and what happens next. The mechanics of how banks reach this position deserve examination. Bank capital is depleted through several mechanisms. The first is loan losses. When borrowers default, banks must write off the loans. Write-offs reduce capital. Enough write-offs can reduce capital to minimum levels. Commercial real estate losses have accelerated over the past 18 months. Office buildings in major cities sit partially empty. Landlords cannot service their debt. Banks hold the mortgages. The losses have not been sudden. They have been persistent. Each quarter, another tranche of loans is recognized as impaired. Each recognition reduces capital. The second mechanism is securities losses. Banks hold substantial portfolios of treasury securities and mortgage-backed securities. These portfolios are supposed to be safe, government-backed, highly rated, stable. But bond prices move inversely to interest rates. When the Federal Reserve raised rates from 0 to 5%, the value of existing bonds fell substantially. A treasury bond purchased at par when rates were 2% might be worth only 80 cents on the dollar when rates reach 5%. These losses are real. The bonds have lost value. But accounting rules allow banks to avoid recognizing the losses if they classify the bonds as held to maturity rather than available for sale. The losses are hidden but not eliminated. They sit on balance sheets, invisible to casual observation, but very real to bank managers who know the true value of their assets. If a bank must sell these bonds before maturity, to meet deposit withdrawals, to raise capital, to satisfy regulatory demands, the hidden losses become realized losses, and realized losses reduce capital. Silicon Valley Bank failed precisely this way. Held to maturity losses became realized losses when depositors withdrew. The realization triggered more withdrawals. The spiral ended in the second largest bank failure in American history. The third mechanism is deposit flight. When depositors withdraw funds, banks must either raise new deposits or sell assets. Selling assets, particularly assets trading below book value, crystallizes losses. Deposit flight has been persistent since 2022. Higher interest rates made money market funds attractive relative to bank deposits. Depositors moved funds, banks lost stable funding. The combination of these 3 mechanisms, loan losses, securities losses, deposit flight, explains how 5 major banks arrived at minimum capital levels. Each mechanism alone might have been manageable. Together, over 18 months, they depleted the buffers that were supposed to provide resilience. The historical pattern of banking stress provides context for the current moment. Banking crises do not announce themselves. They develop invisibly, beneath the surface, until a trigger event reveals the accumulated fragility. In 2007, the banking system appeared stable. Capital ratios met regulatory requirements. Stress tests showed resilience. Confidence was high. Beneath the surface, mortgage losses were accumulating. Securities backed by those mortgages were losing value, but the losses were hidden in complex structures, off-balance sheet vehicles, held to maturity classifications. The trigger came in August 2007, when BNP Paribas suspended redemptions from 3 funds exposed to U.S. mortgage securities. The suspension revealed that assets previously marked at full value might be worth substantially less. Confidence shifted. Interbank lending froze. Institutions that had seemed stable discovered they could not fund themselves. The crisis did not reach its acute phase until September 2008, when Lehman Brothers failed. But the crisis had been building for over a year. The fragility was present long before the failure. The pattern is consistent across banking crises. In 1930 and 1931, bank failures cascaded across the United States. Each failure triggered deposit flight from other banks. Each flight forced asset sales at depressed prices. Each sale created losses that triggered more failures. The fragility had built during the 1920s. Loans had been extended against asset values that proved unsustainable. When values fell, the loans went bad. The system was fragile before the first bank failed. In 1990, the savings and loan crisis reached its culmination. Over 1,000 institutions failed. The Resolution Trust Corporation was created to manage the liquidation. The fragility had built during the 1980s. Deregulation allowed savings and loans to take risks they were not equipped to manage. Commercial real estate lending expanded beyond prudent levels. When property values declined, the institutions failed. The pattern repeats. Fragility builds invisibly. A trigger reveals the fragility. Cascading failures follow. The current moment fits this pattern. Fragility has built over 18 months. Loan losses, securities losses, deposit flight. The buffers that once existed have been depleted. The system has not failed, but the system has reached the state that precedes failure, the state where triggers matter, where small events can cascade, where confidence is the only thing preventing revelation. The Federal Reserve's response to banking stress follows its own pattern. When banks reach minimum capital levels, they stop lending. Lending requires capital. If there is no excess capital, there can be no new loans without replacing existing loans. When lending stops, economic activity contracts. Businesses cannot finance inventory. Homebuyers cannot obtain mortgages. Credit, which is the lifeblood of modern economic activity, stops flowing. The Fed's response to this dynamic is always the same: provide liquidity. In 2008, the Fed created emergency lending facilities to provide banks with cash against collateral that private markets would not accept. In 2020, the Fed created similar facilities, accepting corporate bonds, municipal securities, even exchange-traded funds as collateral for emergency loans. In 2023, following the Silicon Valley Bank failure, the Fed created the Bank Term Funding Program, a facility that allows banks to borrow against Treasury securities at par value, even though the securities trade well below par in the market. Each intervention follows the same logic. If banks cannot fund themselves through private markets, the Fed becomes the funder. If banks hold assets that have lost value, the Fed accepts those assets at values that do not reflect their losses. This logic prevents immediate failure. It does not restore capital. A bank with depleted capital and access to Fed liquidity is still a bank with depleted capital. The liquidity allows the bank to meet withdrawals. It does not allow the bank to make new loans. It does not restore the buffer against future losses. The Fed can prevent runs. It cannot, through liquidity provision alone, restore a banking system to health. Restoring health requires either time, years of retained earnings rebuilding capital slowly, or recapitalization, where new equity is raised to replace lost capital. Time is not available when 5 major banks are at minimum levels simultaneously. The system does not have years. It has until the next trigger event. Recapitalization would require banks to issue new shares, diluting existing shareholders. Bank stocks are already depressed. Issuing shares at current prices would be massively dilutive. Management resists. Shareholders resist. The Fed faces a situation where its primary tool, liquidity provision, addresses the symptom but not the disease, and the tools that would address the disease are not within the Fed's direct control. This is the trap. The Fed can prevent immediate failure. It cannot restore capacity. The system remains at minimum buffer, vulnerable to whatever comes next. Silver's behavior during banking crises follows a recognizable pattern. In 2008, as the banking crisis reached its acute phase, silver initially fell. Liquidity panic triggered selling of all assets, including precious metals. Silver dropped from approximately $19 to below $9 between July and November. But then the Fed's response, Quantitative easing, zero interest rates, emergency lending triggered a reversal. Silver rose from $9 to nearly $50 over the following 3 years. The initial decline reflected liquidation. The subsequent rise reflected the consequence of the policy response, currency debasement through money creation. The pattern has repeated in subsequent crises. Initial liquidation followed by sustained rise as monetary expansion becomes the solution. The current banking stress has not yet reached the acute phase. There has been no Lehman moment, no catalyst that triggers systemic panic, but silver has been rising, from $18 in late 2022 to current levels. The rise anticipates what the policy response will be when the acute phase arrives. This anticipation is not irrational, it is pattern recognition. Market participants who have observed previous cycles understand the sequence. Banking stress leads to Fed intervention, intervention leads to balance sheet expansion, expansion leads to currency dilution, dilution leads to precious metals appreciation. The sequence has played out enough times that anticipation has become embedded in market behavior. Silver does not wait for the crisis to reach its acute phase. Silver prices the probability that the acute phase is approaching and the certainty that the response will be monetary expansion. The relationship between bank capital and precious metals is not obvious but is fundamental. Banks create money through lending. When a bank makes a loan, it creates a deposit. The deposit is new money that did not previously exist. This money creation is constrained by capital. A bank can only lend a multiple of its capital base. The multiple is determined by regulatory requirements. When capital is depleted, the constraint binds. New money creation slows. The money supply, which was expanding through bank lending, stabilizes or contracts. This contraction is deflationary. Less money pursuing the same goods and services means lower prices, all else equal. But the contraction also threatens the banking system. Deflation increases the real burden of debt. Borrowers who owe fixed amounts find those amounts harder to repay as income and asset values decline. Default rates rise. Bank losses increase. Capital depletes further. This is the deflationary spiral that central banks fear above all else. The response to this fear is always monetary expansion. If private money creation through bank lending is contracting, public money creation through central bank policy must expand. Quantitative easing is this response. The Fed creates reserves, base money, to offset the contraction in bank-created money. The base money does not directly enter the economy as spending money, but it provides liquidity that prevents the worst outcomes. The expansion of base money, even if not immediately inflationary, changes the monetary backdrop. More base money exists relative to goods, services, and hard assets. Gold and silver are the hard assets that cannot be expanded by policy. Their supply is constrained by geology, not by central bank decisions. When base money expands and hard asset supply does not, the ratio shifts. More dollars per ounce. The price, expressed in dollars, rises. This is the fundamental link between bank capital stress and precious metals prices. Capital stress leads to lending contraction. Lending contraction triggers central bank expansion. Expansion shifts the ratio between paper money and hard assets. Hard asset prices measured in paper rise. The mechanism is not instantaneous. There are lags, complications, countervailing factors. But the mechanism is real and it explains why silver responds to banking stress even when the connection seems obscure. There are beliefs about bank safety that deserve examination. The first belief is that deposit insurance makes bank runs impossible. Deposit insurance protects depositors up to $250,000 per account. This protection reduces the incentive for small depositors to run. But large depositors, corporations, institutions, wealthy individuals, hold deposits above the insurance limit. These depositors have every incentive to run when bank safety is questioned. Silicon Valley Bank's depositors were overwhelmingly above the insurance limit. When confidence wavered, they withdrew $42 billion in a single day. The run that was supposed to be impossible happened anyway. Deposit insurance prevents small depositor runs. It does not prevent institutional runs. And institutional runs can destroy a bank in hours. The second belief is that stress tests ensure bank resilience. Stress tests model severe economic scenarios, recession, market crashes, credit losses, and evaluate whether banks can survive. But stress tests are only as good as the scenarios they model. They did not model a rapid interest rate increase that would devastate bond portfolios. They did not model a social media accelerated bank run that could drain deposits faster than any historical precedent. The banks that failed in 2023 had passed their stress tests. The tests did not capture the stress that actually occurred. Stress tests provide false comfort. They test for known risks. They cannot test for risks that have not been imagined. The third belief is that banks at minimum capital are still safe because they meet requirements. This belief confuses compliance with resilience. A bank at minimum capital meets its regulatory requirements. It is not in violation, it is not technically distressed. But a bank at minimum capital has no buffer. Any unexpected loss, a loan default, a securities write-down, an operational failure, immediately threatens the minimum. The bank must either raise capital quickly or face regulatory intervention. Meeting minimum requirements is not safety. It is the absence of margin. It is the state where anything that goes wrong becomes a crisis. 5 major banks operating at this state simultaneously is not stability. It is coordinated fragility. The timeline of what happens next is uncertain. The direction is not. Banks at minimum capital do not spontaneously rebuild their buffers. Rebuilding requires retained earnings, profits that are not paid out as dividends. But banking profits are compressed when lending is constrained. The very condition that depleted capital makes rebuilding capital difficult. Banks at minimum capital can raise new equity, but raising equity in a stressed environment is expensive. Investors demand high returns for taking risk. Share prices are depressed, meaning more shares must be issued to raise the same amount of capital. Dilution is severe. Banks at minimum capital can sell assets to reduce their balance sheets. Smaller balance sheets require less capital, but selling assets in a depressed market realizes losses that further reduce capital. The cure can be worse than the disease. The options available to banks at minimum capital are all difficult. Each path has costs. Each path takes time, and time may not be available. A trigger event, a major commercial real estate default, a regional bank failure that spreads contagion, an unexpected economic shock, could accelerate the timeline from months to days. In that acceleration, the Fed would be forced to act. Emergency facilities would be created or expanded. Liquidity would be provided. The immediate crisis would be contained. But containment would require monetary expansion. And monetary expansion would shift the ratio between paper and hard assets. Silver would respond to that shift, not because silver traders are predicting bank failures, because silver reflects the consequence of the policies that prevent bank failures. The mechanism is the message. Prevent failure through expansion. Expansion dilutes currency. Dilution reprices hard assets. Gold accompanies silver in this dynamic, with its own characteristics. Gold is the senior monetary metal. Central banks hold gold as reserves. Gold's market is deeper, more liquid, less volatile. Silver is the junior monetary metal. Central banks do not hold silver. Silver's market is smaller, more volatile, more responsive to shifts in physical demand. In banking crises, both metals respond to the same underlying dynamic, but silver typically moves with greater amplitude. The percentage gains in silver exceed the percentage gains in gold during monetary expansion phases. This is not because silver is superior, it is because silver's smaller market produces larger price swings for the same dollar flow. The gold-silver ratio, currently around 50-1, compresses during monetary stress. It compressed in 2011 to below 40. It compressed in 2020 towards 65 before silver's surge. Ratio compression means silver is outperforming gold. This outperformance is typical of late-cycle monetary stress, when capital flows into hard assets accelerate and the smaller silver market responds more violently. The current banking stress, if it continues or intensifies, would be expected to produce ratio compression. Silver would outperform gold in percentage terms, both would rise in dollar terms. This is not a prediction of specific prices, it is an observation about historical patterns and the mechanisms that produce them. This is not an analysis that suggests imminent bank failures. Banks can operate at minimum capital for extended periods if no trigger event occurs. The Fed can provide liquidity that prevents runs. Regulators can extend forbearance that delays recognition of losses. The system has demonstrated remarkable capacity to persist in stressed conditions without outright failure. But persistence is not the same as stability. A system operating at minimum buffer is not stable. It is merely persisting. And persistence ends when a trigger overwhelms the capacity to manage it. The 5 banks at minimum capital are not failing, they are persisting. They are operating in a state that requires everything to go right, a state where anything going wrong triggers consequences that would not occur if buffers existed. This is the state that precedes systemic stress in every historical episode. Not failure, but fragility. Not crisis, but the conditions that produce crisis when triggers arrive. Gold does not rise. Confidence falls. Silver does not spike. Systems strain. 5 major banks at minimum capital is not a headline. It is a data point in a weekly Fed release that almost no one reads. But data points accumulate. They tell a story for those willing to assemble them. The story is not about individual bank failures. The story is about systemic capacity, the buffer that allows unexpected events to be absorbed without cascade. That buffer has been depleted. Loan losses, securities losses, deposit flight, 18 months of erosion that brought 5 major institutions to the minimum threshold. The threshold is not failure. The threshold is the line below which failure becomes possible. The system is on that line. And what happens next depends on triggers that cannot be predicted. But what happens after the trigger, the policy response, the monetary expansion, the currency dilution, can be anticipated. It has happened before. It will happen again. Silver does not know when. Silver reflects the probability, and the probability, with 5 major banks at minimum capital, has shifted. Not toward certainty, toward recognition. Recognition that the system is strained, that buffers are gone, that the next stress will require response, and that response will have consequences that silver, as it has throughout monetary history, will reflect. For those watching the data, rather than waiting for the headlines, the data is already speaking.